Okay everyone, Assalamu alaikum and welcome to ACCA revision session for paper F7 financial reporting. Today is day 2, 14 November 2017 and let's start today's session. In yesterday's session we have discussed the accounting standards. We have covered tangible non-current assets IAS 16, 40 and 23, and we have already covered financial instruments, but we were about to solve the questions and the session was ended. So we will be continuing from the questions of financial statements. And in today's accounting standards, we are going to cover IAS 12, IFRS 15, IFRS 16, 38, 36, IFRS 5 and 20. I hope that we get sufficient time to cover all of these areas. And the final accounts question that was previously planned for today, I have converted into tomorrow's session. So we will be solving final accounts questions on tomorrow. And then we'll be continuing with consolidation, ratios, and then final mock brief. So let's start from where we had left yesterday. We were discussing financial instruments, where we have discussed financial assets, financial liabilities. In financial liabilities, we have discussed the loan notes and secondly, the convertible loan notes. Convertible loan notes is a hybrid instrument, a compound financial instrument, so it will be having both equity and liability components. So this is one of the final accounts questions with the name of Candy, and this is a trial balance extract where the question has given us the proceeds of 6% loan notes, which is $30,000, and the interest payment to date is of $1,800,000, and both relates to note number 1. So the note number 1 is that the loan notes was issued on 1st October 2013 and our year end is September 14, so which means 1 year back the loan notes were issued and incurred issue cost of $1 million, which were charged to profit or loss. If you remember the treatment of the transaction cost, the treatment of the issue cost, transaction cost and issue cost is the same. So we used to prepare the entry as financial liability debit and bank credit by 1 million, but the question has actually expensed this out in P&L. So the question has made an entry of P&L debit by 1,000 and bank credit by 1,000. So if we prepare the correcting entry would be financial liability debit by 1,000 and P&L credit by 1,000. This is the correcting entry that should be recorded. So this way the loan notes will become 30,000 minus 1,000, which will be $29,000. This is the amount of the loan notes. The question further says that interest of 1.8 million, which is 13 million into 6%, was paid on 30th September 2014, which is the year end. The loan is redeemable on 30th September 2018 at a substantial premium, which gives an effective interest rate of 9% per annum. No other repayments are due until 30th September 2018. So the loan will be paid in 2018, 4 years down the line, which means that this is a non-current liability. So if we prepare the table, we used to prepare it in such a way that here brought down interest expense, interest paid, amortization and carried down. So this is the first year where the brought down will become 29,000. We are not going to use 30,000 because the correct value is actually 29,000. And the interest expense will be 9% on this 29,000, with the interest payment being 1.8 million, 1,800. So if I calculate the interest expense, this will become 29,000 into 9 divided by 100. So the interest expense is of 2610. Thank you, Kuli. So it is 2610 and the difference is going to be 810 of amortization and 29810 for the carried down. So we had to perform the accounting for year 1. So the entry that we are going to prepare is actually interest expense or the finance cost debit by 2610. The amount already paid from the bank is of 1,800 and the financial liability shall be increased by 810. 10. So this amount has already been paid. So this is the entry that should be recorded in the financial statements to record this transaction. Any confusion if you people have? Harsh is asking that what is the requirement of this question? Harsh, basically this is a question relating to final accounts. So in final accounts question, you actually have to prepare the financial statements. So if you look at the answer, the financial liability in the balance sheet should be of 29810, statement of financial position, and the finance cost to be recorded in the statement of comprehensive income should be 2610. So this is actually the answer is. Okay, Harsh is asking again, 810 from where? 810 is Harsh 2610 minus 1800. 2610 minus 1800. Okay. Okay, thank you. Okay, walaikum assalam, Neeraj. Okay, Hamza Ali has a long question. Hamza, your question is too long. Can you please post it on the WhatsApp group? I will answer you there. Okay, so Harsh is saying that I'm confused with this and the hybrid. What's the difference? It is the same, Harsh. This is a hybrid instrument. A convertible loan notes. Sorry, this is not a hybrid instrument. This is a simple loan notes. In a hybrid instrument, we have an option either to receive cash or to convert into shares. The option is with the loan note holder. Okay, what about 5 years? Kuli, the remaining 5 years does not belongs to current year, so we are not going to record for those. The only accounting that we are going to perform is of the current year. Harsh is asking again in SOFP what we put, sir. Harsh, in SOFP we are going to write this 29810 as a non-current liability. Yes, this is a financial instrument question. Shiza Salim is asking from where 29810. Okay, yes, Shiza. 29810 is a non-current liability. So this is a non-current liability in the statement of financial position. We will be solving 3 complete questions of final accounts. So the impact of these, how to incorporate into the final accounts, will be there in tomorrow's session. So don't worry for that. Now let's have another question. Now this time this is a convertible loan notes question, 5% convertible loan note. So this is a hybrid instrument. Now the question says that the following trial balance relates to Extol at 31st March 2014. March 2014 is the year end. And the question is given as the loan note interest and the dividend paid as a combined form. So whenever this is being provided to in a combined form, you have to break it into the amount of interest and into the amount of dividend. So let's see. The question says that on 1st April 2013, which was exactly start of the year. Yes, Saad, convertible loan notes means compound instrument or hybrid instrument. It is the same. So on 1st April 2013, Extol issued 5% $50 million convertible loan notes at par. Now the same 50 million can be seen in the trial balance. Interest is payable annually in arrears on 31st March each year, which is our year end as well. The loan note is redeemable at par or convertible into equity shares at the option of the loan note holders on 31st March 2016. So we have issued in 2013 and it will be redeemed in 16. So how many years? 14, 15, 16. This will be redeemed in 3 years' time. The interest on an equivalent loan note without the conversion rights would be 8% per annum. So 8% is the effective rate in this case. So we will be using these discount factors. So the first step is to break this 50,000 into liability and equity, the amount of liability and equity. So how do we calculate the amount of liability? We actually calculate the present value of all future cash flows. So I'm preparing the table over here, year 1, 2, 3. The cash flows will be 50,000 into 5%, which is 2,500 interest per year. Year 1, 2,500, year 2, 2,500, and year 3, this will become 52,500. 2,500 of interest and 50,000 of loan repayment. So the total would become 52,500. The discount factor will be 0.93, 0.86, and 0.79. So the present value of these is going to be 2,500 into 0.93, which is 2325. So this is going to be 2325. And then 2,500 into 0.86, which is going to be 2,150. And then we have 52,500 into 0.79, which is going to be 4,1,475. So the total is going to be 4,1,475 plus 2,150 plus 2,325, which is going to be 4,5,950. So 4,5,950 is the amount of financial liability. 4,5,950 is the amount of financial liability. Thank you, Neeraj. Thank you, Kohli. Thank you, Saad. Okay, now the second step is to calculate the table, which is year, brought down, interest expense, interest paid, amortization, and carried down. So in year 1, the liability brought down is going to be 4,5,950 that we have just calculated, and we will be calculating interest expense using the 8% rate. So I'm applying 8% on this, which is going to be 3,676. So the interest is 3,676, although the amount paid would have been 2,500 for year 1, which is also a part of interest. So the amortization will become 3,676 minus 2,500. So this will be 1,176. And the carried down will be 1,176 plus 4,5,950, which is going to be 4,7,126. So 4,7,126 will be recorded as a financial liability in the balance sheet. 4,7,126 will be recorded as a financial liability in the balance sheet. 3,676 will be recorded as an interest expense finance cost in the income statement, and 2,6,176 is actually a non-current liability. And apart from this, the third impact is actually the amount of equity. So the amount of equity is 50,000 minus 4,5,950, which is going to be 4,050. So this 4,050 will also be recorded in the statement of financial position, and this will be recorded as a part of equity. So three impacts to be taken: 3,676 in the income statement, SOCI, 4,7,126 in the balance sheet, non-current liability, and the amount of 4,050 in the equity in the statement of financial position. So these were the three impacts that you should incorporate in the income statement. Harsh is asking, what is SOCI? Harsh, SOCI is the income statement of comprehensive income. So you can say P&L, you can say income statement, you can say SOCI, you can say statement of comprehensive income. All the words are mainly the same. Okay, well, Wahid is saying, so why we have taken 5% interest rate for equity component calculation? Actually, Wahid, we have used 5% not to calculate equity, but to calculate the cash flow. The objective of using 5% is to calculate the amount of cash flow. So we are going to pay interest at 5% of the par value of 50,000. So that's why we have used that value. So the interest payment will always be calculated using the coupon rate. This rate is actually called the coupon rate, and interest is paid using the coupon rate. So this will be used over there. Bilal is saying that if the loan is used in mid of the year, amount of interest and paid will prorate. Yes, exactly, Bilal. If you are calculating, if you are issuing the loan in mid of the year, so prorate the number of according to the number of months. So these are the slides that were relating to the previous day, yesterday. And now we have an MCQ as well. Let's read this. Before reading, do remember one thing, that this relates to actually financial asset, where we had two categories: fair value through P&L, fair value through OCI. And fair value through P&L is used for short-term intention assets, and fair value through OCI is used for long-term intention assets. So if we read the question is lengthy, so let's read it together. The question says that included within the financial assets of Zynet Company at 31st March 20X9 are the following two recently purchased investments in publicly traded equity shares. So we have recently acquired shares of two different companies. Investment 1, investment 2. Investment 1 is 10% of the issued share capital of Haruka Company. This shareholding was acquired as a long-term investment as Zynet Company wishes to participate as an active shareholder. So if the intention is long-term, the category is going to be fair value through OCI. And then in the investment 2, the question says that 10% of the issued share capital of Lucas Company. This shareholding was acquired for speculative purposes, and Zynet Company expects to sell these shares in the near future. So the intention is short term, so these will be classified in fair value through P&L. Neither of these shareholding gives Zynet Company significant influence over the investee companies, so we don't have influence. If we would have had the influence, that would become an associate and would not fall under IFRS 9. Okay. Yes, Harsh, because we have purchased it, that's why it's an asset. Wherever possible, the directors of Zynet wish to avoid taking any fair value movement to profit and loss so as to minimize volatility in reporting earnings. So they want to take the movement towards the fair value through P&L. So yes, they can take for the investment 2, but cannot for investment 1, because whenever the intention is long term, we have to classify them in the P&L category. Okay, so what is the answer finally? If we see, the answer is actually D, that how should the fair value movement in these investments be reported in Zynet's financial statements? So for the first investment, this would be recorded in OCI. So in other comprehensive income for investment 1, and for investment 2, these will be recorded in the P&L. So this was an easy MCQ. Okay, let me repeat the wherever possible line. Wherever possible, the directors of Zynet Company wish to avoid taking any fair value movement to P&L. They want to avoid taking the value to P&L so as to minimize volatility in reporting entity, so that the so that the earnings, the profit, are not volatile. To reduce the movement in the P&L, they want to report the earnings in the P&L. So this is a type of manipulation, a type of creative accounting, that they don't want to movement to be taken to P&L. So that's why we are saying that the investment 1 will be taken to OCI because it is long term, and investment 2 because it is short term. So they actually want to avoid fair value movement to P&L. So by avoiding fair value movement to P&L, okay, sorry, by avoiding, sorry again, by avoiding the fair value movement to P&L, the question wants all of the investments to be taken to OCI. So we can take the movement of investment 1 in OCI, but we cannot take the movement of investment 2 in OCI. So the investment 1 will be taken to OCI and 2 will be taken to P&L. Has to reduce the volatility so that the movements are not taken into P&L. Otherwise, sometimes the profit will be higher, sometimes the profit will be lower. So they want all movement to be taken to OCI. Yes, that line is only a distraction because all the investments cannot be classified in OCI just to minimize the volatility. This is not a criteria. The criteria is basically the intention, and we classify the investments according to the intention only. Okay, now it's tax time. Let's discuss IAS 12, income tax. Cooley is saying since they say expect to sell, isn't it long term? Cooley, if they are saying that we are our expectation is to sell, this means the intention is short term. We will sell it in the near future. So this shows that the intention is short term. Okay, Dania is saying please do leases, revenue and tax standards. Dania, okay, we will try our level best. Okay, now let's discuss IAS 12. IAS 12 discusses about the income tax, and there are total 2 areas of income tax, current tax and the deferred tax. So you should be aware of 2 types of income tax, the current tax and the deferred tax. In the current tax, there are 2 types of current tax, the current tax current year and the current tax prior year. These are 2 types of tax. We are going to discuss these in detail. And in the deferred tax, the movement is either taken to P&L or the deferred tax taken is or the movement is taken to revaluation reserve. So in total, you have to remember 4 types of accounting in IAS 12. How to treat current tax current year, how to treat current tax prior year, how to treat deferred tax which is due to P&L, how to treat deferred tax which is due to revaluation reserve. So there are total 4 types of tax accountings that you should be aware of. Okay. Now we are starting with the current tax, with the accounting of the current tax. So the current tax are basically of 2 types, current tax current year and the current tax prior year. What is current tax current year? Expected tax to be paid for the current year profits. This is the amount of tax that we are expecting that we would be paying for the current year's profit. Okay, Smita, here you go. Quickly take the snapshot. Yes, this is an estimate. Ahmed, you can post or you can reply me. Okay. Okay, we have just started the topic, so please be patient. I know you people have a lot of questions, but let me complete the entire story. Only then you people will be able to understand the entire concept. So try not to rush towards the questions and be patient. I will be answering all of your questions, but at the right point of time. Okay, so now the current tax are actually either current tax relating to current year or the prior year. So what is current tax current year? This is the expected tax. The word expected tax is self-explanatory. that this is an estimated amount of tax that we are expecting that we would be paying for the current year's profit. Now, if this is an expected tax, this may differ with the actual amount of tax. If this is an expected tax, this may differ from the actual amount of tax. So any difference between the expected tax and the actual tax is going to be the current tax prior year. Any difference between the expected tax and the actual tax will be called as prior year. Why prior year? Because if I'm calculating the tax for the year ended 31st December 2017, now I have calculated the expected tax on this date. When am I going to get the actual amount of tax? During this year or during the next year? I've calculated the expected tax on December 17. Now the question is, when am I going to get the actual tax in this year or the next year? Obviously next year. So if I'm getting the actual amount of tax over here, now there is a difference. These values are not matching. I'm getting the actual amount of tax on this date. Now the expected tax and the actual tax are different. They are not matching. So the difference is called prior year, and this will be recorded in the year ending 31st December 2018. So for 2018, this is a tax which relates to the prior year. This is a tax which relates to the prior year. That's why we are calling this a prior year current tax. That this was a current tax, but this does not relate to the current year. This actually relates to the prior year. Yes, Harsh. So now there are two elements in 2018. In 2018, we are going to record two elements. One, the prior year impact, the prior year impact of the last year, and second, the current year impact of the current year. So the current tax current year of 2018 and the current tax prior year of 2017, both will be recorded in 2018. Both will be recorded in 2018. So the current tax current year of 18 is also recorded, and the current tax of 17 is also recorded in current year. So now how do we record the entry for current tax current year? Is if the amount is a tax payable, we have to pay a tax, we are going to record tax expense debit, and provision for tax credit, which is also known as tax payable. So this provision for tax will actually become a current liability in the statement of financial position in the balance sheet. So if I'm expecting a tax to be paid for the current year, the entry is going to be tax expense debit and the tax payable credit. And if I'm expecting a tax refund, I'm going to prepare the entry as tax refund debit, which is actually a current asset in the statement of financial position, and the tax expense to be credited. So if I have to pay an amount, this is a current liability. If I have to receive a refund, that is a receivable. So payable, liability, refund, receivable. Payable, liability, and refund, receivable. So this is a current asset and this is a current liability, and the opposite side impact is going to be tax expense. So it will either increase the tax expense or it will either reduce the tax expense. Harsh, because we are going to receive a refund. This is an asset. This is a type of receivable for us. And if we talk about the prior year, there are two types of provisions, an under provision and an over provision. The word under provision means that previously we had understated. Previously we had understated the tax expense. This is what means by under provision. So what will we do? That this will be shown as a debit in the trial balance. and this is going to increase the tax expense of the current year. This is going to increase the tax expense of the current year. So under provision means that we have understated the last year's expense. Now we need to increase the expense of the current year. So we are calling this as under provision. Okay, Saad, I will repeat the entries. So is it clear what is under provision and why is it shown on the debit side and why does it increases the expense? Okay, that's good. Now the second thing is over provision. The over provision means that we had actually overstated the tax expense previously. We had actually overstated the tax expense previously. So now we are going to decrease the tax expense in the current year. So the word over provision means that we have overstated the tax expense in the last year. So now we are going to decrease the tax expense, and this will be shown as a credit in the trial balance. So whenever there is a debit balance in the trial balance, we are going to say that this is an under provision. And if the balance is a credit balance, we are going to say that this is an over provision. Yes, Elvis, debit means understatement of tax expense. Okay. So under provision means that we have understated the expense. So we are now going to increase. And over provision means that we have overstated the expense. So now we are going to decrease. And for the current year, the treatment is pretty simple. You just have to check that whether it is a tax payable or a tax refund. If it is a tax payable, we are going to record as tax expense debit and tax payable or the provision for tax credit. This is a payable liability. And if it is a tax refund, we are going to record the tax refund as a receivable. As an asset, we are going to receive an amount refund. And this is going to reduce the tax expense because this is a type of an income for us. Now let's discuss the deferred tax. The deferred tax movement are of two types. Either the deferred tax is due to a P&L item or it is due to a revaluation item. The deferred tax is actually a quite detailed topic of, if you want a proper understanding of that topic, it would take a lot of time, and that we don't have right now. Considering the exams are too near, we have a limited time of 15 hours. So we will be discussing it with respect to the exam focus only. What to do in the exam, how to do in the exam, that's it. Why to do, not relevant. How to do, relevant. So deferred tax are of two types. Either this is due to a P&L item or this is due to a revaluation. So what do we do? Basically, we actually calculate the deferred tax carried down and we compare it with the brought down. So for example, if the liability, deferred tax liability carried down is 1000 and the brought down was 800, this means that the deferred tax liability is increasing. So this is an increase in the deferred tax liability by 200. So the entry we are going to record is tax expense debit and deferred tax liability credit. Similarly, if I say that no, this was 1800 in the brought down, so this means that the liability is reducing by 800. So the entry would become deferred tax liability debit by 800 and tax expense credit by 800. So what matters is that whether the liability is increasing or the liability is decreasing. But what will happen in the exam, that the brought down will be given. This will be given in the trial balance, and the carried down will have to be calculated by the students. The carried down will have to be calculated by the students. And how do we calculate this deferred tax? This is pretty simple. That deferred tax is equals to tax base minus the carrying amount into the tax rate. Deferred tax is tax base minus the carrying amount into the tax rate. And now if the answer is a positive balance, we call it a deferred tax asset. And if the answer is a negative balance, we called it a deferred tax liability. So how do we calculate the deferred tax? Tax base minus carrying amount into the tax rate. Tax base minus the carrying amount into the tax rate is the deferred tax. If it is positive, it is a deferred tax asset, and if it is negative, it is a deferred tax liability. Okay, Ayaz wants a snapshot of this. Here you go, Ayaz. Okay, so how do we calculate the deferred tax? Is tax base minus the carrying amount into the tax rate, and that will give us the deferred tax. Now, what is tax base? What is tax base and what is carrying amount? Carrying amount is the value as per the IES, and the tax base is the value as per tax authorities. The carrying amount is the value as per IES, and the tax base is the value as per the tax authorities. So this is tax base, Dania. Okay, now let's discuss about revaluation. If there is any deferred tax impact due to revaluation, for example, if we are increasing the asset by $10,000, which is a revaluation gain recorded in revaluation reserve through OCI, if we have a revaluation gain of 10,000, increase in the asset by 10,000, and the tax rate is, let's suppose, 30%, and the tax rate is, let's suppose, 30%. So this would result in a deferred tax liability increasing by $3,000. If the asset is being increased by 10,000, the liability will increase by 30% of 10,000. So whatever is the tax rate multiplied by the revaluation is the amount of deferred tax due to revaluation. Whatever is the amount of revaluation into the tax rate is the amount of the deferred tax due to revaluation. Harsh is saying, sir, considering we have not taken any classes of F7, would this crash class be sufficient to pass the exam? Harsh, now this is a very difficult question from you. Now actually what matters is that what is your brought forward knowledge. Quite a lot of people are able to pass by taking the revision classes only, but some of the people even are unsuccessful by taking only the crash classes. So this all depends upon the brought forward knowledge and how well can you get from this session. Thank you, Tayyaba. Okay, I'm repeating again about the revaluation. So the entry is going to be, if an asset has been revalued upwards, we are going to increase. Okay, let me explain you a bit more in detail, although we are short of time, but let me explain you in detail. Now let's suppose I'm writing a carrying amount, I'm writing the tax base and the temporary difference and the deferred tax. These are 4 columns: carrying amount, tax base, temporary difference, and deferred tax. Now, for example, that I have purchased the land for $100 million. I have purchased the land for $100 million, and the tax authorities do agree that we have purchased for $100 million. So there is no temporary difference and no deferred tax initially. But let's suppose if I revalue my asset upwards, the carrying amount would become 120. And this 20 million would be recorded as a revaluation gain in OCI. Now, do tax authorities also revalue the asset? Do the tax authorities also revalue the asset? No. So the tax basis will remain 100. So the temporary difference of tax base 100 minus the carrying amount of 120 is going to give us a temporary difference of negative 20. A negative 20, which means this will become a deferred tax liability, but after multiplying by the tax rate. So assuming a 30% tax rate, this would become a deferred tax liability of $6 million because this is a negative value. So always there will be a deferred tax liability due to the revaluation. It can never be a deferred tax asset. Umar, it can never be a deferred tax asset. It would always be a deferred tax liability. It will always be a deferred tax liability. And same is the answer for Shazad's question, that it can never be a deferred tax asset. It will always be a deferred tax liability. Okay, so now what will be the entry? Now we are recording the deferred tax liability by $6 million. I'm referring to this example. Now the question arises, why are we debiting the revaluation reserve? Why are we debiting the revaluation reserve? Why not tax expense? Why not tax expense? Why revaluation reserve? The answer is pretty simple. That where is the revaluation gain recorded? Where is the revaluation gain recorded? It is recorded in OCI. So the tax should also be recorded in OCI. If the gain is in OCI, the tax should also be in OCI. If the gain would have been in P&L, the tax also would have also been in the P&L. So the treatment should be like with like. If the gain is in OCI, the tax should also be in OCI. If the gain is in P&L, the tax should also be in P&L matching concept. Treat the expense in a similar way as the income has been treated. So if the income is in OCI, the tax is also in OCI. Tayyaba, in case of a revaluation loss, you are not required to calculate the deferred tax because that would already be covered over here. That would already be covered over here in the P&L item because a loss is recorded in P&L. We are talking about the revaluation that is being recorded in OCI only, which is the revaluation gain. So if there is a revaluation loss, you don't have to do anything. It will automatically be recorded. So this is why we have actually recorded the impact in the revaluation reserve, which was also a question of one of the students. Let me check, who was it? It was Fyong. Fyong, your name is a bit difficult for me. So Fyong had the same question, that why are we debiting the revaluation reserve? So we are debiting because the gain is also recorded in the revaluation reserve in the OCI. So the tax should also be recorded over there. So the treatment should be like with like according to the matching concept. Okay, now we are done with IAS 12. We will be solving the questions of IAS 12 in the final accounts questions tomorrow. So it is recommended if you people revise IAS 12 before coming to the session tomorrow. Do revise this once and then come back. Now we are going to discuss IFRS 15, which is revenue from contract with customers. IFRS 15 actually has two different areas. Okay, a lot of people wants to get the WhatsApp group link. I'm sharing my number. You people can drop me an SMS and I will provide you the link to be added into the group. This is my personal contact number, so you people can drop me an SMS on WhatsApp. I will be sharing you the link with you people. Yes, Tayyaba, everyone can join this session. I would request the admin to kindly post the link of how to join. Yes, Danya, I will be solving the questions of tax in tomorrow's session with the final accounts, because this is normally asked in the final accounts. Okay, now let's have an overview of IFRS 15. There are actually 5 steps. This is a 5-step model that we are going to discuss of recognizing the revenue. So the first step is to identify the contract. The word identify the contract means to check if the contract is complete or not. So a contract is complete when it is approved by both parties. A contract is identified when it has been approved by both the parties. So if me and you are signing a contract, I have approved it, but you have not approved it. If me and you are signing a contract, I have approved it, but you haven't approved it, is the contract complete? The answer is no, because we still haven't agreed with the terms and conditions. So if we haven't agreed the terms and conditions and I'm selling you the goods, we haven't actually agreed with the terms and conditions and I'm selling you the goods, the standard says that you cannot record the revenue because right now the contract has not yet been approved. So it should be approved by both the parties and the payment terms should be defined. The payment terms should be defined, that exactly what amount am I going to receive or what amount exactly you are going to receive. Which means that we should have agreed on a price. If we have not yet agreed on a price, this means that revenue cannot be recognized. The acceptance can be both written or oral, but it should be accepted by both parties. And the third thing is that the inflow of the payment is probable. If the inflow is probable, only then we are going to consider that the contract is complete. This means if I'm selling goods to a customer, who is in a financial difficulty, I'm selling goods to a customer who is in a financial difficulty, can we record the revenue? The answer is no, because if the customer is in a financial difficulty, the inflow is not probable. If the customer is in a financial difficulty, this means that the inflow is not probable and we cannot record the revenue in this case. Zoeb wants to take a snapshot of the previous slide. Zoeb, here you go. Quickly take the snapshot. Okay. So now there are three important points: that it should be approved by both the parties. The payment term should be identified. What exactly amount am I going to pay or I'm going to receive? It should be clearly defined. Third, the inflow should be probable. If the inflow is not probable, we cannot record the revenue. Now the second step number 2, when the contract has been identified that it has been complete, the second point is to identify the performance objectives. What are performance objectives? The performance objectives are actually the promise that we have done to provide goods or services. What is performance objective? It is the promise to provide the goods or services. Like for example, I've promised you that I will be providing 5 pens to you. I will be providing 5 pens to you. So how many objectives are there? 1 or 5? How many performance objectives are there? 1 or 5? Okay, 1, 1, 1. Harsh is saying 5. 1, 1, 1. Yes, exactly. This is a one performance objective. This is only one performance objective because I'm providing the pen. Yes, we can say that if I've promised to provide you 5 pen, this is one objective. And if I've delivered you only 1 pen right now, I would say 20% of the objective has been completed. Out of 5, I have provided you 1, which means 20% of the percentage has been completed. I have provided you 2 pen out of 5 so far, 40% task completed. I have provided you 3 pen, 60% task completed. I have provided you 4 pen, 80% task completed. I have provided you 5 pen, 100% task completed. But the objective is only one. We are going to divide it into percentage so that if only 1, 2 or 3 or 4 or 5 pen are delivered, we can record the percentage accordingly. Angela is saying, what if all of one of the three you said is not present? Can I still add? No, Angela, actually all of the points should be met. If any one is not met, the contract is not complete. If any one is not met, the contract is not complete. All of the points should be met simultaneously. Okay, Deng Nigo is asking a question. If we cannot record the revenue but the goods still delivered to customer, is this a loss, sir? Yes, exactly. Deng, this is a loss. If I have provided you pen, I have sold pen to you, but I'm not expecting an inflow from your side. I have sold the pen to you, and I haven't. I'm not expecting an inflow from your side. This means that I'm at a loss. I have made a loss transaction, selling something to someone from whom no benefit can be received. Harsh wants to understand the payment term again. Harsh, payment terms means that when the amount will be paid, what amount will be paid, how it will be paid, through banking channel, through cash, what will be the mode of payment, what amount of payment, when will the payment made. So you can say payment terms actually means three areas: when the amount will be paid, what amount will be paid, and what will be the mode of the payment. Okay, Shiza is saying all which points? 5 steps or all of step 1 points? Shiza, all of step 1 points. The question was relating to all of the 3 points relating to step number 1. Yes, Zohaib, the approval can be verbal. Smita is saying, sir, how is it possible to know the probability of inflow? Actually, Smita, we will not exactly know whether it's probable or not. It will be an estimate. It will actually be an estimate that will we be receiving, such as, for example, if there's a customer who has been delaying payments since long, and now we have heard that he's defaulting on other payments. So this means that he would default on our payment as well. So this is all about what information do we have that will decide whether inflow is probable or not. Okay, so the step number 2 is to identify the performance objectives. Now I'm repeating my example. I have promised you, this is an example, not a promise. I have promised you that I will be providing 5 pens to you. Now this is one objective. If I say I'm going to provide you 5 pen and 5 tablets, 5 pen, 5 tablets. Now how many objectives are there? I'm going to provide you 5 pens and 5 objectives. Yes, exactly. There are now total 2 objectives. There are now total 2 objectives. Yes, Tayyaba, probable means more than 50 and possible means less than 50. So now I'm providing you 5 pen and 5 tablets. These are 2 performance objectives. But let's suppose, do listen this carefully. Now this is a difficult one. If I say I'm going to provide 5 the pen tops to you and the 5 pen bottoms to you. The pen tops 5 and the pen bottoms 5. Now are these 2 objectives or 1 objective? I'm providing you 5 pen tops and 5 pen bottoms. 2 objectives or 1 objective? Okay, majority of the people are saying 2. Arslan Beg is saying 1. Okay, now do listen this carefully. We are going to treat this as a 1 objective. As a 1 objective, because can someone use this? I'm selling you 5 pen tops. How will you use this? Obviously you cannot use this. So the objective has no meaning because it cannot be used by the customer until the bottom has also been received. And similarly, if I'm selling you only this, there's no top, there's a bottom. The pen won't work. Even if I write on the screen, the pen won't work. So how are you able to obtain the benefit from this? So this is actually a single objective. So sometimes what happens is that the plant, there's a big plant, which is being provided in chunks. Some part of the plant transferred, some part of the plant transferred, and then some part of the plant transferred, and then accumulated to be used by the customer. So if a single plant has been provided in 3 different parts, this is one objective. If a plant has been provided in 3 different parts, this is one objective. Good, Tayyaba has understood this point. Muhammad Nabil Anwar is saying, what if they can have from someone else, the other part? Nabil, basically the overall concept, if I tell, is that the performance objective is distinct if can be sold separately. The performance objective is distinct. Distinct means we are going to count them 2 if they can be sold separately. So if this can be sold separately in the market and this bottom can be sold separately in the market, only then these are 2 objectives. But if in the market they cannot be sold separately, this is only one objective in that case. So if both the parts can be sold separately, 2 objectives. Cannot be sold separately, 1 objective. If both these parts can be sold separately, 2 objective. Cannot be sold separately, 1 objective. Yes, Cooley. Thank you, Dalal. So in step 2, we are actually identifying the performance objectives. Shiza, for which exactly do you want an example? Because I have already just discussed this in too much of detail. Okay, so now step 2 is to identify the performance objectives, where we are identifying the number of goods, distinct goods that can be sold separately. For example, the tablet and the pen can be sold separately. These are distinct. The tablet and the pen can be sold separately. These are distinct. The tablet and the keyboard, this keyboard, they can be sold separately, 2 objectives. They cannot be sold separately, 1 objective. So the treatment is simple, that anything that can be sold separately is a distinct goods, is a separate objective. Anything that cannot be sold separately is a single objective. Elvis is saying an example could be a copybook and a phone. Yes, exactly, Elvis. Thank you for another example. And Shizai is saying, okay, if it's a contract to be sold together and we have sold one of them first, then the other. Shizai, the contract, irrespective of the contract, if any of the goods can be sold separately, there are 2 objectives. If we are delivering them together, still 2 objectives. Delivering them separately, 2 objectives. Okay, now let's move on to the step number 3. The step 3 is to identify the transaction price now. What do we mean by identifying the transaction price? Is the first thing that this is the amount that actually we are going to receive. Transaction price is the amount that we expect to receive. Transaction price is the amount that we expect to receive. This is the amount that we are going to receive. So if I'm selling you 5 pens, the amount that I'm going to receive is the transaction price. But this should exclude any amount received on behalf of someone else. The transaction price should exclude any amount received on behalf of someone else. So for example, if we see any product, if you purchase from the market, does that product includes the sales tax, the value added tax, VAT, VAT? if you go into the market and you purchase anything, are you going to pay the sales tax as well? The answer is yes. You would be paying the sales tax as well. So I'm a company, I'm charging $100 from the customer, and I'm charging 20% sales tax from the customer. So the total amount that I'm receiving is 120. Now this 20 actually relates to the sales tax. So what amount of revenue should I record? What amount of revenue should I record? 100 or 120? 100. Everyone is saying 100. So yes, the answer is 100 because the amount of 20, I have received it on behalf of the tax authorities. That is not my amount. I have received this from the customer on behalf of the tax authorities. So that is not a part of the transaction price. Similarly, if I write down the examples in the bracket, I'm going to say tax is one of the examples. And the second example is actually commission sales. For example, I'm an agent. You want to sell your property. I am the property agent. You want to sell your property. I'm the property agent, and I have a buyer who is going to purchase from you. You are the seller. I am the agent. He is the buyer. I am the agent. What amount am I going to receive? I'm going to receive a commission. But I am receiving the entire amount from the customer, and then I'm going to pay you that. I'm going to receive the entire amount from the customer, and then I'm going to pay you that. So what amount of revenue should I record? The entire amount or the commission only? I'm receiving the entire amount from the customer, and then I'm going to pay you that. Should I be recording the commission or the entire amount? Yes, commission. Everyone is saying commission. So that is the common sense. I would record the commission only because the remaining amount, I have actually received that on your behalf. I have received the remaining amount on your behalf. That is not my revenue. That is your revenue. So whenever we are receiving an amount on behalf of any third party, we are not going to record it as a revenue. We are only going to record the revenue of our own amount, the amount that we are receiving on our own. That will be recorded as a revenue. So transaction price, by transaction price, we mean the price that we are going to receive actually, that we expect to receive in our pockets, not any amount which is payable to anyone else. Now the fourth step is allocation of the transaction price to the performance objectives. Now the first step is to allocate the transaction price to the performance objectives. Hamza, if these cannot be sold separately, then this is one objective. If these cannot be sold separately, this is one objective. Okay, so step number 4 is to allocate the transaction price, the price that we have calculated over here, to the performance objectives, into the performance objective that we have identified over here. So for example, I'm selling you two products. Product A and product B. I'm selling you two products, product A and product B. The product A is of $8,000 and the product B is of $2,000, and the total is $10,000. I'm selling you two products under the same agreement. Product A 8,000, product B 2,000. No, Harsh, the performance objective means the promise, the goods or services that we have discussed in step number 2. The performance objective means the promises that we have done to provide goods or services. Dania is saying, sir, you said 5 pens is one objective, but all 5 pens can be sold separately. Then why one objective? Basically, Dania, 5 pens, yes, they can be sold separately, but this is one good. This is one good. We are not going to divide even the goods. So for example, if I'm selling you 100 tablets, this is one objective. But if I'm selling you 100 tablets and 100 batteries of the tablets separately, this is again one objective, because the tablet and the battery cannot be sold separately in the market in normal circumstances. Used batteries can be sold, but normally the laptop and the batteries cannot be sold separately. So that will become one objective. So we are not talking about the quantum of the quantum of the pen, even if it's 1 pen, 100 pen, thousands pen, 1 million pen. This is one objective. Ignore the quantum. This is one good. So that is why one objective. Okay. So now we are discussing how to allocate the transaction price to the performance objectives. So now I'm selling you two products, product A, product B. Product A is of 8,000, product B is of 2,000. And I'm charging you 10,000. So what price should be allocated to product A? I'm charging 10,000. What price should be allocated to product A? Obviously 8,000. What price should be allocated to product B? Obviously 2,000. So that is pretty common sense, that product A is of 8,000 and product B is of 2,000. But for example, if I say that I am going to sell you these products at a discount and I'm going to charge only 9,000 from you for both the assets. So I'm charging 9,000 from you for both. Now what amount is for product A and what amount for product B? Now what do you think? What amount for product A out of 9,000 and what amount for product B? Average. Cooley is saying average. Arslan is saying prorate. Yumna is saying 7,200 for product A. Yumna is right. Shiza is saying prorate accordingly. Shiza also right. And Harsh is also right. Okay, a lot of, I think everyone is answering the correct answer. So you people are already professionals of IFRS 15. So actually if we see, the product A is 80% of the total. Out of 10,000, product A is 80% and product B is 20%. Out of the total 10,000, product A is 80% and product B is 20%. So 80% of 9,000 would relate to product A and 20% of 9,000 would relate to product B. So this will become the breakup of the price. So this is how we have allocated the transaction price over the performance objectives. And we have used 8,000, 2,000 and 10,000 to calculate the percentages. So these are actually known as standalone prices. These are actually known as standalone prices. So the standard says that in step 4, the allocation should be based on standalone prices. According to IFRS 15, the allocation should be based on the standalone prices. So this is how we have completed step number 4. Now the last step, step 5, is to recognize revenue when the performance objectives are satisfied. So whenever we are delivering product A, record the revenue for product A, delivering product B, record the revenue for product B, delivering 5 pens, record the revenue for 5 pens, delivering 5 laptops, record the revenue of 5 laptops. So you have to recognize the revenue according to the percentage of completion. Whichever task has been done, record the revenue for that. Whatever task has been done, record the revenue for that. So this was the 5-step model. Is everyone clear on this? Is everyone clear on this? Okay, that's good. Good to see that Harsh is also clear, because Harsh was in a panic mode before starting IFRS 15. So Harsh, be rest assured, we will be completing every task in as much good way as we can. Okay, so step 5 is basically the that whenever we are completing the promise, recognize the revenue. Whenever we are completing the promise, recognize the revenue. So for example, if ACCA would have charged you for this session, so $50 for 5 sessions, let's suppose, a rough value, $50 per student for 5 sessions. So up to now, I would have said that day 1 has been completed, so 20% task completed. Day 2 half done, so it's approximately 30% task completed. So this is how we have calculated the percentage of completion. No, Neeraj, we will not be covering the construction contract area because that is lengthy and time consuming. Zuhaib wants to repeat step number 4. Zuhaib, quickly repeating step 4. Step 4 is that we are allocating the price onto the objectives, and we are going to allocate them on a standalone basis. So if product A is of 8,000, product B is of 2,000 out of 10. So product A is 80% and product B is 20%. So if I'm charging 9,000 for both on a discount, so 80% of 9,000 is for A and 20% of 9,000 is for B. Okay, now we are going to discuss some of these specific cases. Specific cases are more relevant in a final accounts question in the preparation of the entity specific financials. Yes, Harsh, you are right. Whatever promise we have fulfilled, we will recognize the revenue. Yes, Shiza, prorate will be done when we have any discounts. No need of going into too much detail, Hamza Ali. Smita is saying, sir, please mention the subtopics you won't be discussing under each IAS or IFRS. Smita, this is a difficult question because F7 is a pool of knowledge and we are covering some part of that. So a lot of part is also left. So I think that we are already covering the majority items which are more important for the exam. So there is no need of going into too much detail of what is not being done. Otherwise that would create a pressure on you. But how to cover that? Yes, Harsh. Neeraj is saying that it is enough to cover 50 marks. Yes, Neeraj, inshallah we will be able to cover the topics that will be sufficient enough for you people to obtain 50% of the marks. Just give me a second. Okay, everyone, let's resume now. So in the specific cases, we are actually going to discuss 4 cases. The 5th case, the construction contract, is a quite more detailed area. So we will not be able to cover that. So we'll be discussing first 4 specific cases. The first case is a sale or return basis. Now, what is a sale or return basis? Elvis is saying, I just did my mock and performed below average. What assurance is there that I can make a pass in the pending exam? Elvis, no one can obviously give you the assurance that you would pass other than your result. that whether you are passed or not. So I think that after the session, try another mock and see that how much are you able to score now. Okay, Simeon is saying that I'm new here, but I appreciate this session. How can I get day handout? Okay, Simeon, actually you would be having an option of handouts on the right hand screen, where there will be an arrow and the information about the session. You can find the handout section. Okay, you are asking for day one. The admin will be sharing you the group link of WhatsApp. So you can ask over there, so people will be happy to share the slides with you over there. Saad, we will see if we can cover or not. Harsh, the construction contract is there in F7. Still it is there in F7, but we will not be discussing that. Okay, now let's start with sale or return basis. What is sale or return basis? For example, the company goes to a retailer. The company goes to a retailer and asks the retailer to purchase the goods from the company. For example, I am the company and you are the retailer. I am the company and you are the retailer. Now I come to you and say that this is a brand new pen, a new company which is going to be a super hit in the market. Keep this pen with you and people will come and buy from you. Now I'm the company and you are the retailer. I'm selling my pen to you. And you say nobody has asked yet about this pen. I say, but people will ask you. And now you are the retailer. You say, what is the surety? What is the guarantee? What if you purchase the pen and nobody comes to buy? You are at a loss. So now I want to sell the pen to you, but you don't want to buy because you feel a risk that nobody will buy and you will be at a loss. So now what I can do is I can say you that, okay, fine, don't worry. I'm selling you this on a sale or return basis. You try to sell in the market. You try to sell these goods in the market. If you are able to sell, give me the cash. If you are able to sell, give me the cash. If you are not able to sell, return me the pen. You are not at a loss in any case. If you are able to sell, I've given you 100 pen, you are able to sell 30, give me the price for 30. And if you are not able to sell the remaining 70, give me the 70 back. You are not at a loss. Now this is called sale or return basis. Either you sell in the market or you return it back to me. Either you sell in the market or you return it back to me. Now in this case, how are we going to record the revenue? We say that the revenue is recognized. The revenue is recognized on the basis of expectation. The revenue is recognized on the basis of expectation. So for example, if I have sold you $100 million of goods and I am expecting that 30% of the goods will be sold and you will be able to sell 30% of the goods and provide me cash for that. So I will be recording the revenue of $30 million. I will be recording the revenue of $30 million. Yes, Harsh, this is called consignment stock. This is from the perspective of the seller. We are going to discuss in the entire accounting from the perspective of the seller. So I've sold you $100 million and I think that you will be able to sell 30% and give me cash for 30%. So I should recognize the revenue for $30 million, not for the rest. I should record the revenue for $30 million and not for the rest. But if I'm not sure that what amount of revenue am I going to get, if I'm not sure what amount of revenue am I going to get, in that case, I should not record any revenue. In that case, I should not record any revenue. So the percentage that I'm recording should be probable, at least probable. Okay, Smith is saying, what if we are able to sell more? It can be even more or less. So for example, I was expecting that the customer will be able to sell 30, but he has sold 40. So that's good. I will record the remaining 10 revenue as well. But when the customer has already sold. So right now I'm recording 30. Thank you, Muhammad Anan. So right now I'm recording 30. Any difference will be adjusted later. Any difference will be adjusted later when the difference arises, when the difference will arise. So right now we are recording 30. If we are getting 40, good enough, record further 10. If we have recognized 30 but we are getting 20, that's bad, reverse 10. So if we are receiving more, record more. If we are receiving less, reverse. If we are receiving more, record more. If we are receiving less, then we will have to reverse some of the amount. Yes, Meta, more or less will be adjusted with the actual sales. No, Tayyaba, you cannot record the provision. Previously we used to do this, but after the implementation of IFRS 15, we do not record a provision. No, Junaid, we cannot record a deferred income. Deferred income is something else. Okay, now, so this is all for the sale or return basis. And one more thing, if the question does not mentions you this percentage, if the percentage is not given in the question, this would mean that no revenue should be recorded. If the percentage is not given in the question, this would mean that no revenue should be recorded. If the percentage has been given in the question, this means that this much amount of revenue should be recorded. So we are going to record this much revenue if it is being given in the question, otherwise not. Yes, wrong. This will become an adjusting event in that case. Mahmood, you can write the question over here where you are writing that how can I chat. You are already in the chat. You can simply post your question. I am able to see all of the points that you people are writing. Shira, this percentage is coming from the question. This percentage is coming from the question. So we are depending on the question for this percentage. Zoeb is saying that if I'm not expected any revenue, so these goods should be shown in my inventory. Yes, Zoeb, this will be shown in your inventory. Umar Rashid is asking that what should we do with the remaining 70 million? Umar, we are going to record the inventory of 70 million in our books. This is our inventory but held with someone else. This is our inventory but held with someone else. So we are not recording the revenue of 70 and the inventory will still be recorded in my books. Yes, Harsh, you are right. Ali Khan is saying if they have given the actual sale rather than expectation, yes, Ali Khan, then we will be using the actual sales in that case. Yes, Harsh, we are recording according to the seller's perspective. Okay, thank you, Harsh. Now let's continue because we have to complete the target as well. And there are a lot of questions from you people. I try to answer each and every of them, but obviously the answer to your question has a cost of something being left at the end. So the question you people are asking, try to be specific and try to be short so that you people are easily able to understand my replies and we are consuming less time. So let's move on to the commission sales. The commission sales we have already discussed, that we will be recording the commission as an income only. Commission will be recorded as revenue. For commission sales, these are the amounts where you were the seller, someone was the buyer and I was the agent. So for the agent, the commission is only the amount of the revenue. Any amount received further is a payable. If I have received the entire amount from the customer, my commission is mine, the remaining amount is my payable to you. So we have already discussed this. Let's discuss sale and repurchase. In sale and repurchase, what happens is, for example, an entity A sells goods to entity B for $100 million. Entity A sells goods to B for $100 million. With an agreement to buy them back for $121 million. After 1 year, A has sold goods to B for $100 million with an agreement to buy them back for 121 after a year. So this means that the additional amount that I'm paying, which is 21, why am I paying additional amount 21? Why should I pay an additional amount of 21? And even why should I buy back actually? I have sold the goods. Why should I buy back? Because yes, this transaction is actually a loan agreement. This is not a sale agreement. This is a loan agreement. We have in actual taken a loan. Yes, Junaid. Yes, Harsh. That this is a loan where I'm receiving $100 million and I'm giving the goods as a security. I'm not selling them to you. I am giving them to you to keep as a security, and when I repay the loan, I will get my goods back. So this is a collateral loan. This is a collateral loan. What is a collateral loan? Where we have given some security. That is called a collateral loan. So this is a loan agreement. So for A, the correct entry should be bank debit by $100 million and financial liability credit by $100 million. This is a loan agreement. And the additional $21 million is an interest. This is a finance cost to me. So I should record finance cost of 21 million and financial liability of 21 million at the end of the year. So this entry is of year 0 and the interest is being recorded at year 1. No, Harsh, the buyer cannot use the asset because that is not the asset I have given him. This is the asset that I have given him as a security. Yes, Neeraj, we will also be recording the goods as an inventory because we haven't sold them. The goods are ours. They have been kept by someone else. So these are actually the correct entries that should be recorded in the question in case of a sale and repurchase agreement. So any entry recorded should be reversed. Any entry already recorded in the question by the question should be reversed. So if the question has already recorded the revenue, we are going to reverse that. If the question has already recorded a revenue, we are going to reverse that. Okay, Harsh wants me to specify what is debit and what is credit. Bank is debit, liability is credit, finance cost is debit, financial liability is credit. Okay, I will try to repeat the sale or return. Hi, Mohammad Zishan. No, Shiza, we are not going to record this as a revenue because in actual we haven't sold anything. In actual, we haven't sold anything. We have taken a loan. Okay, now let's discuss the goods and services. This is a case where we are selling the goods and we are giving the services both. So what we will do in this case? Okay, Ali Khan is saying what goes in income statement and what in balance sheet. Ali, the finance cost will go into the income statement and the financial liability of 121 will go to the balance sheet. Bilal, you don't need to go into too much detail of buying back at fair value. Yes, Harsh. Yes, Zohaib. We are going to prorate the interest if the entire year has not passed by. Yes, Kuli, you are right. Yes, exactly, Taiba, you are right. Okay, now let's move on to case number 4. Now we are selling the goods and we are selling the services both. For example, I have sold you this pen. I've sold you the pen. I've sold you the pen and I've said that I will give you warranty for the next 3 years. I've sold you the pen and the admin is requesting to give the break because it's mid of the session. So let me complete the statement and then I will give the break. Thank you for the cooperation. Okay, so we were discussing that we have sold the goods. I'm selling you this pen and plus I'm giving you services for the next 3 years. Let's say maintenance services for the next 3 years. Now, should I record the revenue of the goods? Yes, whenever the goods are sold, the revenue should be recorded. But for services, they basically relate to 3 years, out of which if 1 year has passed, we can record the revenue for the year. But for the remaining 2 years, we cannot record the revenue for that period. So the goods, revenue record. For 3 year service, revenue being recorded for 1 year, and the remaining 2 years are actually an unearned income for us. We have received the amount, but we haven't earned that. So this is going to be an unearned income for 2 years. Is this a current liability or a non-current? The 2 year service is unearned income, current liability or non-current? Yes, 1 year current and 1 year non-current. This is both. Out of 2 years, the first year is current and the second year is non-current. So this 2 years would relate both to current and non-current. So that is all with IFRS 15. And you have a question for IFRS 15. One thing I'm going to tell you further, and then you are going to try this after the break. That, for example, Ahmed wants to have the screenshot. Ahmed, quickly take the screenshot. Okay, Lee is saying that debit what and credit what. Let me write it down. In this case, we are actually going to say bank debit, revenue credit for the goods and for the 1 year service, and then the unearned income non-current liability and the unearned income current liability. This is the correct entry that should be recorded. Harsh is saying why financial liability, Harsh? Because this is a loan. Loan is a financial liability obligation to deliver cash. So all answers being done. So try this on your own, and do remember one thing, that if I have sold goods, today and I'm going to receive amount 2 years down the line, or I'm going to receive 50% amount in year 1 and 50% amount in year 2. So what amount of revenue should be recorded? The sales should be recorded at the present value of all cash flows. The sales should be recorded at the present value of all cash flows. Izzy Bakum is asking for repetition of one thing. Okay. I would request you people, if there's something you have actually missed out, do cover that from the recorded session, because we are already short of time. So we are taking a break of 10 minutes. And the 10 minutes break is actually starting at 11:32 with me. So we will resume at 11:42. So let's have a break and then continue again. Okay, everyone, and let's continue after the break. So the question says that Hindenburg is a car retailer on 1st April 2014, which was start of the year. Hindenburg sold a car to Latry on the following terms. The selling price of the car was 25300 and the customer has paid 12,650, half of the cost on the same date. On 1st April 2014, half of the price has been received. So I would say 50% amount has been received in year 0 today and would pay the remaining 12,650 on 31st March 2016, which is 2 years down the line, 2 years after the sale. Hindenburg's cost of capital is 10% per annum. What is the total amount which Hindenburg should credit it to profit and loss in respect of this transaction in the year ended 31st March 2015? So have you people calculated it? What amount should be recorded? So the first thing is that we are going to calculate the amount of the sales. So this is going to be 12,650. I'm writing here cash flow. I'm receiving 12,650 into today and 12,650 down the line after 2 years. So I'm going to multiply this with the discount factor and then I'm going to get the present value. So I'm going to say 1 divided by 1.10 to the power 2. So this is the discount factor, 0.907. No, am I wrong? 1 divided by 1.1 power 2. This is going to be 0.826. Okay. So the discount factor is 0.826 and today it's 1. So 12,650 would remain as it is. And if I multiply this with 12,650, I'm going to get 10455. 10455. So if I calculate the answer, this is going to be plus 12,650, which is going to be 23105. So the sales will be recorded by 23105, but the question has not asked us the amount of the sales. The question has asked us the amount, the total amount that will be recorded in the profit and loss. So if I write down the entry, if I write down the accounting entry, I'm going to say that the entry is bank debit by 12,650, this amount that I've received, and receivables debit by 10455, this amount. This is going to be received in year 2, and revenue credit by 23105. This is the entry for the revenue. But the question is not asked as the revenue, the question is asked as the entire amount. So now, this receivable of 10455 will then be unwound at each year end. So the entry is going to be receivable debit and P&L credit, income credit by 10455 into 10%, which is going to be 1045.5. So the amount being recorded in P&L is actually 23105 plus 1045.5. So now if I add this, 23105 plus 1045.5, I'm going to get 24,150.5. So the answer is D in this case. So we have actually recorded two elements. Simran is saying that I was too fast. Okay, Simran, let me explain you again. Are you clear with this? Simran, are you clear with this? Okay, I will repeat the second entry. Okay, that's good. So the first entry is clear. Let me discuss the second entry and the amount in P&L. Actually, the amount that is we have recorded as receivable is 10455. But what amount are we going to get after 2 years? What amount are we going to get after 2 years? We have recorded 10455, but what amount are we going to get in the future after 2 years? What amount of cash are we going to receive? It's not 10455. Yes, we are going to receive 12650, the remaining balance. We are going to receive the remaining balance of 12650. But we have recorded the receivable at a lower amount. This means that we have to unwind the receivable for the 2 years. So what will happen in actual, that 10455 will be unwound by 10%, which will be 1045.5 in the first year. And if I calculate the sum, this would become 10455 plus 1045.5. So the total would become 11,500 approximately. And then we are going to again unwind this in the second year again by 11,500 into 10%, which will become 1150, and the sum would become 11,500 plus 1150. So this would become 12,650, the same amount that we had expected to receive. So when we have recorded the receivable, we have actually recorded it at the present value. And anything which is recorded at present value is then unwound at each year and then increased. So the receivable being recorded at present value will be increased each year. Cooley is saying that the discount factor should be 0.909 for year 1. Yes, Cooley, you are right, but I have not written year 1 anywhere. I've written year 0 and year 2. So the discount factor of year 2 is 0.826 and for year 0 is 1. For us, it's not 2091, it's 11,500 because it's 10455 plus 1045.5. So the values are different. Okay, Ali Khan is saying, sir, every time when we take the present values, something, is it necessary to calculate unwind? Yes, Ali. Whenever you calculate anything at present value, it is then unwound. It is necessary to unwind it every time. Okay. Zuhaib Ali, I didn't get your question. Please repeat. Neeraj is saying, what about year 1 interest? Actually, Neeraj, this is the interest of year 1 that we have just recorded. 1045.5. This is also an income for us. So the total income would become 24150.5. So by the way, why are we unwinding the amount of 10455? Muhammad Unayan, I have discussed this in detail already. That if we don't unwind this, the receivable will remain at 10455, but I'm going to receive 12650. So where would I record the difference at that point of time if I don't unwind? Yes, Nabil, you are right. Simran is saying 11500 is year 2. No, Simran, 11500 is year 1. 10455 is year 0. 11500 is year 1 and 12650 is year 2. Yes, this entry is actually, this entry we have recorded at year 0, and this entry we are recording at year 1. Yes, Simran, 23105 is at year 0, and then 1045.5 is at year 1, so the total would become the answer of this question. Yes, because year 0 is also part of year 1, Simran. Year 0 is start of year 1 and year 1 is end of year 1. Both are year 1 in actual. So both will be recorded in year 1. Dania is saying, sir, will we record revenue of 23105 in P&L year 2 again? No, Dania, you will not record the revenue in year 2 again. It's only relating to year 1. Zoe is saying, kindly show how you have calculated the discount factor. Zohaib, discount factor, the formula of discount factor is 1 divided by 1 plus I to the power n. So I've done 1 divided by 1.10 to the power 2, which is 0.826. Okay, Simran is saying, why did you add 23105 to P&L at year 1? Simran, because the sale is on the first day of the year, so that is also a part for the year. The first day of the year is also a part of the year, and the last day of the year is also a part of the year. So the amount recorded on at the start of year 1 and at the end of year 1, both will be recorded in P&L, because the question is asking for the year. Yes, Shiza, you have got the point now. So the revenue to be recorded is actually 24150. This is the final answer of the question. Okay, now let's move towards IFRS 16. Actually, we are starting today's session from over here because the previous was relating to the last year. Yes, Shiza, remaining in the next year. So let's start IFRS 16. This is the topic of leases, a topic newly introduced in 2017 July. So let's start discussing this. Previously, we used to classify leases into operating and finance. Now that is no more. So the accounting, there are two accounting that you have to remember, the accounting for lease and the exceptions. Let's discuss the exception first, and then we'll be moving towards the lease. This is the normal rule of accounting for lessee. This is the normal accounting for lease. But there are two exceptions where we are not going to follow this accounting. What are the two exceptions? If the asset is a low value asset, the value of the asset is very low, or the lease is of a short-term lease, which is less than a year, in that case, we are not going to apply the normal lease accounting. Instead, we are going to apply another accounting. So there are two accountings, the normal accounting and the accounting for exceptions. Normal accounting and the accounting for exceptions, two accounting. So if the asset is a low value asset, for example, office furniture is a low value asset. For example, your personal computer is a low value asset. So if the asset is a low value asset or a short-term lease, which relates to less than a year, in that case, the accounting is to record the rentals as an expense on straight line basis. In case of exceptions, in case of a low value asset or in case of a short-term lease, the accounting is to record the rentals as an expense on a straight line basis. Now, what does the word straight line basis means? That the expense is equals to total payments, total amount of payments divided by the lease term. So for example, there is a low value asset and we have agreed that we are going to pay rentals of $10,000 in year 1 and $15,000 in year 2. So the total rentals are $25,000. So let's suppose the question says that this is a low value asset. Now calculate the amount of the rent expense. So the answer is pretty simple. The total payment is 25,000 and lease term is actually 2 years. So the annual expense is 12,500. So this is the amount of annual expense. So this exception is applicable on low value asset or short-term lease. If any of one of the cases there, then the exception will apply. If the lease has a low value asset, exception will apply. If the lease is less than a year, high value, still the exception will apply. So both conditions are not to be met, only a single condition met is enough. So we are going to apply exceptions even if the single condition, if any one condition is met, and the accounting is going to be expense as the total payment divided by the lease term. Simran is asking lease, but what is meant by lease basis? Simran, it means that for every lease the treatment can be different. Lease by lease basis means for every lease the treatment can be different. Yes, Cooley, we are going to amortize now. We are going to spread the expense over 2 years. Now let's discuss the accounting for a normal lease. In case of a normal lease, the accounting is pretty simple. We are going to record the right to use, which means the asset. We are going to record the right to use, which means the asset debit, and the lease liability credit. Lease liability is recorded at the present value of all future cash flows. Lease liability is recorded at the present value of all future cash flows. Ali Khan is saying, what do we mean by low value asset? Is there any amount specified? No, Ali. Low value, there is no amount specified with the low value. It can be any amount according to the company. Because for you, low value may be something different. For me, low value may be different. For the company, low value may be different. For everyone, the low value may be different. So this will be decided by the company. Zoeb is saying at the end of the lease, the ownership will transfer still the same treatment. Zoeb, normally in case of low value asset, the ownership is not transferred. Simeon, yes, the low value is subjective and will depend on the company's threshold. The company is going to decide the materiality, that what amount is low value and what amount is not low value. So this will actually depend on the company. Yes, they will specify in the question, Smita, that whether it's a low value or not. So you should know the accounting only, that for low value, this is the accounting. You are not going to identify whether the asset is low value or not. You should know the accounting, in which case which accounting should apply. So in normal lease, the accounting is right to use asset debit, lease liability credit by the present value of all future cash flows, and bank credit by any amount which has already been paid. If we have already paid any amount, the bank will be credited by that amount. Now this is the entry for year 0, which is also a part of year 1, but at the start of year 1. And then at the end of year 1, we are going to record the finance cost debit and the lease liability credit. Finance cost debit and the lease liability credit. This lease liability is actually a current liability. This lease liability is actually a current liability. And whenever we are going to pay the rentals, the bank will be credited and the lease liability will be debited. Whenever we are paying the rentals, the bank will be credited and the lease liability will be debited. Now you have to remember these 3 accounting entries. Yes, Simran, it is unwinding. Okay, so right to use is the total. Right to use is the total of bank and the lease liability. So I can say this is a type of a balancing figure. Right to use is a type of a balancing figure, the sum of the lease liability in the bank. Now let's have a question to understand this in more detail. Understanding with a question would make it more easier. Simran, quickly take the snapshot. Shiza, the unwinding is already included in the treatment that we are going to follow. So let's see the treatment. This is example number 1 where the rentals are in arrears. An entity acquired a plant on lease for 4 years on 1st January 2010. So the lease is for 4 years starting from January 2010 with an annual lease rentals of 12 million payable at the end of each year. So the rentals are 12 million. Implicit rate in the lease was 10%. So the rate implicit in the lease is 10%. The present value of minimum lease payment, by minimum lease payment question means present value of all cash flows, was 38. So this is something which is not necessarily be informed to you in the question. So we are going to actually recalculate this even. So if I calculate the answer, I would say first step is to calculate the present value of all future cash flows. So the entry is going to be right to use debit. Right to use debit lease liability credit by which amount? By the present value. So here 1, 2, 3, 4. The cash flow is going to be 12, 12, 12, 12. And the discount factor is going to be 10%. So I'm directly calculating the present value using the calculator. So 12 divided by 1.1 will give me the present value for year 1, which is 10.91. So I'm writing 10.9. Similarly, 12 divided by 1.1 to the power 2 will give me the present value for year 2, which is 9.9 again. And then I'm going to write the present value for year 3. So this will be 12 divided by 1.1 to the power. And why can't I apply the power? So this will become 12 divided by 1.1 to the power 3. So this is going to be 9. And in the last year, I would say 12 divided by 1.1 to the power 4, which is going to be 8.2. So now if I calculate the sum of all, I would say 10.9 plus 9.9 plus 9 plus 8.2 is going to give me 38, which was already given in the question as well. So if it is given in the question, you can use the value from the question, but if it is not given in the question, you will have to calculate it. The reason why I have recalculated it, so that you people know how to calculate that if not given in the question. So I'm writing the entry right to use debit by 38 and the lease liability credit by 38. This is the entry number 1 that we had to prepare. Now I'm making the lease table for year 1, year 2, year 3 and year 4. So the brought down of the lease is 38. Interest will be calculated using the implicit rate of 10%, which was 3.8, and the rentals that we have paid is 12. So the repayment is 12 minus 3.8, which is going to be 8.2, and the carried down is 38 minus 8.2, which will become 29.8. So this is how we have calculated the value for year 1. The lease table for year 1. If there's any question you can ask. We are going to treat the treatment. We are going to discuss your question, Ali Khan, in the next example, example number 2. So in year 2, the brought down is 29.8 and the interest rate is going to be 10%, which is approximately 3. So 12 rentals, repayment of 9, and the carried down is going to be 20.8. In the third year, the amount is going to be 20.8 and the 10% is going to be approximately 2, or I would say 2.1. So 12 rentals minus will become 9.9 and the carried down will become 10.9. So in the last year the brought down is 10.9, which will become 1.1. 12 we are going to deduct, which will become again 10.9, and the carried down is going to be 0. So this is how the lease liability is going to be repaid. This is how the lease liability is going to be repaid in 4 years time. Coolly 8.2 is written over here. This is the repayment, 12 minus 3.8. 8.2 is 12 minus 3.8. So any questions so far you can ask? What's RTU and LL? Simran, RTU is the right to use and LL is the lease liability. RTU is the right to use and LL is the lease liability. Yes, Ali Khan, we are going to charge the depreciation. We haven't completed the entry yet. Faraz is saying in loan notes we add and lease we add up the total. Yes, Faraz, basically in loan notes we increase the liability, in lease we decrease the liability. This is the difference. Yes, I will be writing, don't worry. Okay, let me complete the entry because the remaining questions are relating to those. So now this was the first entry that we have recorded in year 0. Now for year 1, I'm going to write finance cost debit and the lease liability credit by 3.8. Finance cost debit, lease liability credit by 3.8. And then I'm going to write lease rentals debit, lease liability debit by 12 and the bank credit by 12. So actually what I've done, I've written this 3.8 over here and this 12 over here. So the interest of 3.8 is being recorded as finance cost, lease liability, and the amount repaid is of 12. Now the value to be recorded in the statement of comprehensive income is going to be 3.8. You can call this SOCI, you can call this income statement, you can call this P&L. All names are correct. And in the balance sheet, in the statement of financial position or the balance sheet, the value to be recorded is going to be in actual 29.8. This is the liability at the end of year 1. The liability is actually 29.8, but out of this, the next repayment of 9 will actually become a current liability. And the next repayment of carried down of 20.8 is going to become the non-current liability. So 9 is the current liability and 20.8 is the non-current liability. So this is the breakup of 29.8 which will be taken to the balance sheet. So in P&L total is 3.8 and the balance sheet the total is 29.8, and apart from this we also have to depreciate the asset. So the depreciation expense is going to be 38 divided by 4, which is going to be 9.5. So the depreciation expense debit and the right to use asset credit by 9.5. So the property, plant, equipment in the balance sheet in the statement of financial position is going to be 38 minus 9.5, which is going to be 28.5. So three values were important: finance cost of 3.8, non-current current liability of 9 and 20.8, and asset of 28.5. Okay, a lot of questions being posted. Tayyib is saying how 28.5? Here 28.5 is actually 38 minus 9.5. 38 minus 9.5. So this is 28.5. Zohaib is asking, depreciation depends on life of the asset or lease. Basically, normally in this case, it will be lease. Or you can say lower of the lease term and the life of the asset. No, Shiza, the lease liability of 3.8 has already been paid. So that's why you are not going to record this in the lease liability. Simran, 12 is the amount of the rentals that we had agreed in the question. Mohammed Nabil, 9.5 is the depreciation, which is actually 12 divided by 38 divided by 4. This is actually 38 divided by 4. So this is the amount of depreciation, 9.5. Tayyaba is saying, so there is a liability of 29.8 and also an asset of 28.5 both. Yes, Tayyaba, both are there. Yes, Simran, I'm debiting the lease liability by 12 and reducing it by 12 because we have paid the rentals. So the amount has already been paid. Done, go, all the depreciation will remain the same in all of the years, all of the 4 years. Dania Chaudhary is saying why we have written 12, Tanya, because we have repaid the rentals of 12. So that's why we have debited 12. Talal is saying, sir, the only difference between IAS 17 and IFRS 16 is exception rule. Yes, Talal, you can say mainly. The accounting is more or less the same. There is no change as such. Cooley is saying, is the difference between balance sheet amount and the non-current will be current? Yes, exactly, Cooley. Smita wants to know the clarification of 29.8. Minimize calculator, please. Okay. Yes, Mohammed Nabil, depreciation will be taken to P&L. Okay, there's a question. Why do we need the repayment column? We need the repayment column actually to calculate the current liability. So actually the total liability is 29.8, out of which this is current and this is non-current. So to calculate the current and the non-current breakup, that's why we are making the repayment column. Yes, this is a tough topic, but one of the importance as well. So let's move on to example number 2. This time the rentals are in advance. So the question says that an entity acquired a plant on lease for 4 years. This time this 38 is not there. This is a misprint. So an entity has acquired a plant on lease for 4 years on 1st January 2010 with an annual rentals of $12 million payable at the start of each year. So now we are going to pay the rentals at the start. Implicit rate in the lease is 10%. So this is the same question. The only difference is that the rentals are in advance now. So the first step, if you remember, is the right to use debit and the lease liability credit. By which amount? By the present value. So this time if I write down the present values, I'm going to say year 1, 2 and 3. Because we have already paid the first annual rentals of $12 million. So the first rentals of $12 million will be credited from the bank. The first rentals of $12 million will be credited from the bank. So the present value will now relate to remaining 3 years, 12, 12, 12. And the present value will become 12 divided by 1.1, which is 10.9. And year 2 was 9.9 and year 3 was 9. I'm actually referring to the same values in the previous example. because the answer would obviously be same. So this will become 10.9 plus 9.9 plus 9, which is going to be 29.8. So the present value of all future cash flows is now 29.8. Thank you, Neeraj. So the lease liability will become 29.8, and the right to use is the total of these. So 29.8 plus 12 will give us the value of 41.8. So this time the right to use asset is of 41.8. So the depreciation will be calculated as 41.8 divided by 4. The depreciation will be 41.8 divided by 4, which is going to be 10.45. And the lease liability will be used in the table, which is 29.8. The interest is going to be 10%, which is 2.98. So let's call this approximately 3. The interest is 3, the rentals are 12, the repayment is 9, the carried down is 20.8. In year 2, the brought down is 20.8, 10% is going to be 2.1, rentals are 12, repayment is 9.9, the carried down is 10.9. And in the last year, the brought down is 10.9, the interest is 1.1, the rentals are 12, the carried down is the repayment is 10.9, and the carried down is 0. So this is pretty much of the same table as of the last question. Now the entry is going to be finance cost debit by 3 and the lease liability credit by 3 and the lease liability debit by, okay, now this is something new for you people. Now these rentals, on which date are we going to pay these rentals? We are going to pay this at the start of each year. So this means that this 12 million is the second rentals. The first rentals were of 12, which we have credited the bank. We have credited the bank with this. And these 12 millions are actually the rentals that we are going to pay at the start of the next year. So have we paid this, or we are going to pay this? If this 12 million, which I've written in year 1, is this paid or being or is a payable? What do you think? Yes, Harsh, you are right. We are going to pay this. We are going to pay this. This is a payable because this is going to be paid tomorrow, the next day. This is going to be paid tomorrow. So I'm right now not making the entry as lease liability debit and bank credit by 12. This entry will not be made because this entry will be made tomorrow morning. Tomorrow morning. This is not right now. So if I prepare another year, the next year I'm going to write lease liability debit bank credit by 12 and then the finance cost of 2.1 and the lease liability of 2.1. So these rentals are being paid in the next year. Similarly, these rentals will be paid in the further next year and these rentals will be paid in the last year. So year 1 rentals are now paid in year 2, year 2 rentals are now paid in year 3, and year 3 rentals are now paid in year 4. So this means that $3 million is actually a current liability. So this means that the lease liability of $3 million is a current liability. So what is the liability at the end? The liability is 20.8, same as in the last case, out of which 10.9 is non-current and 9.9 is current. So if I write out of 20.8, current liability is 9.9 plus 3. Which 3? This 3. So the total would become 12.9 and the non-current liability is actually 10.9. This one. So this is how we have calculated the current and the non-current liability. Now let's see your questions. Bilal is saying, but there should be no interest in year 1. Why, Bilal? There should be interest in year 1 because we have used the loan in year 1. So obviously there will be an interest which is actually paid in the next year but relates to year 1. It relates to year 1 but will be paid in year 2. No, even in advance, Bilal, the interest will be there. Even if you are paying the rentals in advance, the interest is there. Shiza is saying, sir, if start of each, then why not year zero? Shiza, for what are you talking about year zero? Kuli is saying, where is the matching principle? Kufi, the entire accounting is according to the matching principle. Yes, Shiza, we have written the rentals of year zero over here. These are the rentals of year zero, 12 million, the first rentals. So we have actually already incorporated the rentals of year zero. Okay, Simran is saying, please repeat the finance cost of 3 and lease liability of 3. Simran, the finance cost for the first year was actually 3, for which we have recorded the finance cost, and this will be paid along with these 12, which are being paid in the next year. So this 3 is also a lease liability to us. This 3 is also a lease liability to us. Okay, now let's move further. Simeon is asking, why are we doing 3 years? Simeon, because we are doing 3 years because the first rentals have already been paid. First rentals have already been paid. So that's why only 3 rentals are left. Okay, Simran is asking which years, please specify. Actually, Simran, there were 3 years. The first is year 0, 1, 2, and 3. So the first rentals we have credited from the bank, and then year 1, 2, and 3 are there. Yes, Danya, you are right. Maz wants to take a snapshot. Maz, here you go. Take the snapshot. Simran also wants to take the snapshot. Tayyaba is saying, what will be the entry instead of lease liability? Tayyaba, I didn't get your question. Bilal is saying that the answers, some kit answers are wrong. Please solve those with us. Actually, Bilal, we are not allowed to use the exam kits on the online classes because that would require a proper license to use the exam kits online. So as we don't have that license, we are not allowed to solve the BPP or the Kaplan exam kits. Okay, now let's discuss the last area. This is sale and leaseback. The last area is going to be sale and leaseback. And this is again something which is quite difficult. This is again something which is quite difficult. So let's see. If I have sold an asset, for example, if there's an entity A who has sold an asset to B and then leased it back from B. We have sold the asset to B and then we have leased it back from B. So such agreements are called sale and leaseback. This is something similar to sale and buyback, but a bit different. This is quite similar, but a bit different. So let's see, Simran, how far can we go in today's session? So sale and leaseback, what do we do? The bank will be debited by the amount of the sale proceeds that we have received to sell an asset. Sale proceeds debit, and the asset being credited by the carrying amount. We are going to de-recognize the asset by the carrying amount, and we are going to debit the bank by the sale proceeds. Amount received bank debit, asset gone credit. Now, this was the entry for sale, but then we have leased back the asset. So to record the lease, we are debiting the right to use and crediting the lease liability. The bank in the asset is for the disposal. When I've sold the asset, I've received cash, bank debit, asset sold, asset gone, asset credit. Bank debit, asset credit, sold, and then I have leased it back. So right to use debit and lease liability credit. Now the balancing figure is going to be P&L. The balancing figure is going to be P&L. So lease liability will be recorded by what amount? By the present value of all future cash flows. Lease liability will be recorded by all future cash flows. Now the only thing is left, the right to use. By which amount are we going to record the right to use? By the carrying amount into the percentage that we have retained. Into the percentage that we have retained, and the percentage retained is over here. The percentage retained is calculated as lease liability divided by the fair value. Lease liability divided by the fair value. So let's look at the question and then see how do we have to solve this. This is example number 3, sale and leaseback transaction. Where the question says that an entity sold a plant with a carrying amount of $80 million. So I'm writing down the carrying amount was $80 million and its fair value was $100 million. So an entity sold a plant with a carrying amount of 80 at its fair value of 100. So this is both the fair value and the sale proceeds. So if I prepare the entry, I would say I've received the bank by 100 and the asset should be credited by 80. Asset gone of 80, cash received for 100. The plant had a remaining life of 10 years. On the same date, the plant was leased back for the next 6 years. So out of 10 years remaining life, I'm only going to use 6 years. So am I leasing back the 100% of the asset? No. Am I leasing back the 100% of the asset? No. I'm leasing back how much percent of the asset? Approximately. Approximately, I would say somewhere near 60%. Somewhere near 60%, because out of 10 I'm using only 6 years. So I have not transferred 100% of the asset. I have transferred only approximately 40% of the asset. With annual rentals of $12 million payable in arrears, the implicit rate is 10%. So now I'm going to credit the lease liability and debit the right to use, and then the balancing figure is P&L. So how I'm going to calculate the lease liability? I'm going to write here 1, 2, 3, 4, 5, 6, 12, 12, 12, 12, 12, 12. And I'm going to convert these into present values. Okay, Neeraj has already calculated the present value. It is 52.26. Thank you, Neeraj. So the present value is 52.26. The present value is 52.26. I'm assuming that Neeraj is right. I'm assuming that Neeraj is right. So the lease liability is going to be 52.26. Now the only thing left is right to use, and the right to use is going to be calculated using the percentage retained. And the percentage retained is going to be the lease liability of 52.26 divided by 100, which was the fair value of the asset. So we are going to get 52.26% is the percentage that we have retained. The percentage that we have retained is actually 52.26. Thank you, Saad. So the right to use is going to be the carrying amount of 80 into 52.26%. The right to use is going to be 80 into 52.26%. So the answer is 41.8. So the right to use asset is 41.8. And now the balancing figure is going to be P&L. So it's 100 plus 41.8 minus 80 minus 52.26. So the answer is on the credit side by 9.54. So the balancing figure is on the credit side. Thank you, Shiza. So this is the final answer in this case. So this is the gain on disposal. Yes, Lee, this is the gain on disposal. Yes, Simran, 9.24 is the balancing figure. Smitha wants to know how we have calculated the percentage retained. Smitha, the percentage retained has a formula. If I move back onto the previous slide. Meanwhile, someone wanted to take the snap. Quickly take the snap, Hamza Ali. So Simran, this is the way we calculate the percentage retained. Smitha, sorry. Smitha, this is the procedure of calculating the percentage retained, the lease liability divided by the fair value. So the lease liability we have calculated is 52.26 and the fair value was actually 100. So this is how we have calculated the percentage retained. So if I even prove you logically, the carrying amount was 80 and we have disposed of for 100. The carrying amount was 80 and we have disposed of for 100. So the gain is 20. But have we transferred 100% of the asset? What do you think? The gain is 20. Have we transferred 100% of the asset? No. Then how much percent have been transferred? No, Zoeb, not 60. No, Simran, not 52.26. No, Hamza, not 40. No, Cooley, not 18. Yes, Harsh, 47.74. This is the right answer. Yes, Neeraj, 47. Yes, Simeon, yes, Simran. Actually, we have retained 52.26, which means we have transferred 47.74%. So if we calculate the gain on the percentage that we have transferred, this would become 20 into 47.74%. That is going to be 9.54. And this is the answer that we have calculated. So we are actually recording the gain on disposal only to the extent of the percentage of the asset that has been transferred. The percentage retained cannot be recorded as a gain and the percentage transferred should be recorded as a gain. Simran is asking what is the meaning of retained. Simran, actually if we see the asset's life was 10 years and after selling we are still using for 6 years. So we are still using the asset, which means we have retained the asset for the next 6 years. So how much percent have we retained? We have retained 52.26%. So this was actually all about IFRS 16. Okay, Simran wants a snapshot. Yes, Simran, hope we all pass, inshallah. Harsh is saying, sir, can you do 1 year's journal entry when we pay the next year lease payment? Harsh, if you are talking about a complete question, I would say that we are already 15 minutes remaining for the session, and we have IAS 38, we have IAS 36, we have IFRS 5, and we have IAS 20. So 4 standards are left. Just give me a second. Okay, now we are left actually with 4 accounting standards, and we have only 15 minutes left. So I think we will not be able to complete this, but I would suggest if you people want, we can extend the session for 20 more minutes up to 120. What is your suggestion? Should we extend the session to 120? If your consent is there. Yes, 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 agreed, extend. Okay, sure, sure. That's good. Okay, so we will try to cover as much as we can up to 120. So let's start IAS 38, intangible assets. Intangible assets are of two types. Either these will be purchased or will be internally developed. Either we are going to purchase the intangible asset or we are going to internally develop them. If the intangible assets are purchased, there are two criteria which should be met. There are two criteria which should be met. The cost can be measured reliably and the probable economic benefit should be there. The cost should be measurable. The cost should be measured reliably and the probable economic benefit should be there. And obviously, if I'm purchasing an asset, is it possible I don't know the cost? I've purchased this pen, but I don't know the cost. That's pretty stupid. I've purchased the asset, although there was no benefit. Again, that is something not acceptable. If I've purchased an asset, I know the cost and I know that there is economic benefit. So we say that the above criteria are by default met. And therefore, every purchased intangible asset is always capitalized. Every purchased intangible asset is always capitalized. 1 second. Okay. So the first point was we are going to capitalize the purchase asset if two criteria are met, and both of them are obviously going to be met by default. And if, for example, I have purchased this pen, and after purchasing, I think, oh, what I've done. After purchasing, I think, oh, what I've done. I've taken a wrong decision. Now what? I've purchased the pen. Now I think that I've taken a wrong decision. What should I do? What should I do? I've purchased the pen and now thinking I don't know what to do. Should I capitalize this or expense this? No, obviously there's an option to sell, but the question is that should I capitalize the amount of the pen or should I expense it out? Nabil is saying capitalize, Simran is saying expense, Kuri is saying capitalize, Smita is saying expense. Okay, this should still be capitalized. This should still be capitalized. This should still be capitalized. The standard says that every purchased asset should be capitalized. In case of any uncertainty, if you have problem after purchasing the asset, impairment testing will be done. IAS 38 is not allowed to expense the purchased asset. IAS 38 is required to capitalize it. If there's any uncertainty that I've taken a wrong decision or what, go to IAS 36, test the asset for impairment. But you cannot directly expense this amount out. You have to capitalize first, and then you have to test it for impairment under IAS 36. So according to 38, every purchased asset is always capitalized, irrespective of whether you find it useful or you find it not to be useful. If there's any problem, go to 36, test for impairment. Simran is saying, but if you don't know what to do, economic benefit will probably not flow right. Yes, Simran, if I'm exactly not sure that what I've done, still there is an economic benefit. I can sell the asset into the market and can gain the cash. So if I've taken a wrong decision, this does not mean that I cannot sell it back or I cannot return it back. So IAS 36 is going to decide what options, what possibilities of usefulness is there for the pen. And 36 will calculate its value in use, that if we use, what will be the benefit, and if we sell, what will be the benefit, what should we do, what is the higher of, and what should be the loss. So all these tasks will be done by 36, not by 38. Harsh is saying, can we classify it as IAS 40? Not at all, Harsh. Not at all. Because this is not a property. IAS 40 is only investment property. We have discussed this in the scope of IAS 40, that only property can be classified in IAS 40, nothing else. Now the last point is, even if we have purchased a research project, normally the researches are expensed out. But those researches that we do as an internal development, not those which we have purchased. If we have purchased a research, that will be capitalized as an asset. So every purchased asset is capitalized, every purchased asset. If it is research, capitalize. If it is useful, capitalize. If it is just rubbish, capitalize, because you have purchased it. 36 will decide whether to expense or not. So we say that every purchased asset is always capitalized. Simran is asking, what do you mean by purchase or research? Simran, you were doing a research for your own. And I have purchased that research from you. You were doing research for your own and I have purchased that research for you. So for me, this is a purchase research. So I should capitalize the research cost. Yes, this is second-hand information. Tayyaba is saying if it's development, it should be capitalized, or even if it's research. No, Tayyaba, we are going to discuss how internal development is going to be dealt. So now let's see that if we are internally developing an asset, there are two phases, research phase and a development phase. The researches are of two types, internal, external, and third party. What is internal research? In-house research. What is internal research? In-house research. What is external research? Outsourced research. And what is third-party research? This is something done for a customer. So internal research is I am doing the research for myself. This is an internal research. I'm doing my research is being done by you. This is called external research. My research is being done by you. This is called external research. I'm doing my research on my own. Internal research. I'm doing a research for you. Third party research. I'm doing a research for you, third party research. You are doing a research for me, external research for me. External research for me. I'm doing the research on my own, internal research for me. So now there's a question, what is the difference between external research and a purchase research? Now there's a question that you have to answer. What is the difference between an external research and a purchase research? What is the difference between an external research and a purchase research? Yes, Simran, you are right. Yes, basically, if you were doing a project for your own, if you were doing a project for your own and I have purchased it, that is a purchase research. If you were doing a research for your own and I have purchased it, this is a purchase research. And if you were doing the research from me, you were doing the research for me from the start, that is an external research. So a research being initiated for me is external research. A research initiated for someone else and I have purchased it from the midway, that is a purchase research. So purchase research will be capitalized and external research will be expensed out. Okay, so external, so the third party research is actually a revenue for me. This is a revenue. I would be charging the third party for doing the research. And the internal and external research will actually be expensed out. So now there are total 4 types of research: internal, external, third party, and purchased. Internal, external, third party, and purchased. Internal, external are expensed, third party is revenue, purchase is an asset. Now let's talk about the development cost. Now the internal development has actually 2 phases: the research phase, whether to do or not; the development phase, to do. Research phase, whether to do or not. Research phase is actually a feasibility stage. This is a feasibility study, deciding whether to do this work or not to do this work. And development is actually doing the work. So development cost is actually capitalized if certain criteria are met. Development cost is capitalized if certain criteria are met. Which criteria? 3 criteria. In fact, 5 criteria. In total, 5. The first is that the project should be technically feasible, which means that we should have the technical skills required. We should have the technical skills required. So if an accountant decides to make a building, this is not a work of an accountant, so that is not technically feasible for him to prepare a building. And for example, an engineer decides to make a financial statements. An engineer decides to make a financial statements, that is not technically feasible for him. If an accountant is if an accountant is deciding to become a doctor and to operate someone, so he's not a doctor, that is not technically feasible for him. So the project should be technically feasible so that we have technical skills. Yes, Simran, we can outsource the technical skills, but right now we are discussing that if we have an option to outsource, the project is technically feasible. But if we are planning it to do it ourselves, that is not technically feasible. The second point is it should be commercially viable, which means that the expected inflows should exceed the expected outflows. It should be commercially viable, which means that there should be a profit. The inflows should exceed the expected outflows. And the third point is that the intention and ability is to complete the asset either for use or to sell. The intention and ability is to complete the asset either for use or to sell. That I'm planning to complete the asset and then use it, and I have the ability to complete the asset to use it. But for example, if the law restricts me not to do this, what I'm doing, so this is not, so I would say that I don't have the ability to complete, because the law would enforce me and would not would not allow me to complete. So I should have the intention and ability to complete, both intention and ability to complete. So these are actually three criteria. Apart from this, there are two more, which we have already discussed in purchased asset. The cost can be measured reliably and the probable economic benefit should be there. So the cost can be measured reliably and the probable economic benefit should be there. So total 5 criteria: cost reliably measurable, economic benefit should be there, it should be technically feasible, it should be commercially viable, and the intention and the ability should be there to complete the asset, either for use or to sell. No, Shiza, external research is not purchased research. External research is that you are doing the research for me from the start. This is external. And the purchase research is someone was doing the research for his own and then we have purchased it. So there's a difference between both. Okay, now let's discuss the next point. The reinstatement is not allowed. Reinstatement is not allowed. What is this? Let's suppose that we are developing an asset which will take 3 years. We are developing an asset which will take 3 years approximately. At the end of the first year, the criteria were not being met. At the end of the first year, the criteria were not being met, and we have incurred $10 million. We have incurred $10 million. Should we expense this 10 million or should we capitalize this 10 million? The criteria are not met. Should we expense or should we capitalize? Simran is saying expense. Arslan is saying expense. Expense, expense, expense. A big list of expense. Yes, obviously expense because the criteria are not met. But let's suppose at the start of year 2, the estimate changes and now the criteria are being met. The estimate changes and now the criteria are being met. And we have incurred $15 million in year 2. So as the criteria are met, we are going to capitalize. As the criteria are met, we are going to capitalize. But what about the previous 10 that we have expensed? Should we capitalize it back or not? What about the previous 10? Should we capitalize or not? The answer is no, as many people already know. So this is called reinstatement, capitalizing the previous amount expensed, which is not allowed. Reinstatement means capitalizing the previous amount which has been expensed, which is not allowed. So once an amount has been expensed, as it was not meeting the criteria, now you cannot capitalize it back. If you have already expensed this out, then there is no way to capitalize it back. You have to the amount should be remain as expense, that as this is a change in accounting estimate, so it should be dealt prospectively. So this should be dealt prospectively. And the last point is that if the development cost cannot be separately identified, if I have paid someone $20 million for both research and development, now I don't know what is the breakup of this 20 million, what amount for research and what for development, I don't know. I've paid $20 million for both research and development. Now I don't know what is the amount of research and what is the amount of development. So what will we do? We are going to expense the entire amount. We are going to expense out the entire $20 million because the breakup cannot be identified. So we are going to expense the entire amount. Ahmad, the lectures will be uploaded tomorrow morning, so you can view all of those areas. We have actually covered IFRS 15 today, IFRS 16 today, IAS 12 today, and now we are doing IAS 38. So this is our 4th topic in today's class. Okay, now let's discuss about the life. The life can either be finite or it can be indefinite. The life can be finite or definite, it is the same thing. The life can be finite or definite, or the life can be indefinite. If the life is finite, we are going to amortize the asset at the end of each year. If the life is finite or definite, we are going to amortize this at the end of each year. And if the life is indefinite, if life is indefinite, we are going to impairment test at each year end. What does the word indefinite means? Undefined. Which means that the life is undefined, such as my and your life. We are not going to live forever. We are going to die someday, but when? We don't know. The life is limited, but we don't know. This means that the life is undefined. This means that the life is indefinite. We are going to extend till 1:20, which makes us 15 minutes more to have discussions. So if the life is indefinite, undefined, we are going to impairment test this at each year end. And plus, we are going to reassess the life at each year end. If the life changes from indefinite to finite, it will be treated prospectively as a change in accounting estimate under IAS 8. So the life, if the life is indefinite, we have to, if the life is indefinite, we have to reassess this at each year end. And then once the life changes, we have to deal this prospectively as a change in accounting estimate. Harsh wants a snapshot of the previous slide. Here you go. So these are some basic points that you have to remember in IAS 38. So I'm skipping the question. You have to solve this at your own. But I'm telling you the answer. So you can take the snapshot of the answer and then you can try it on your own, and then if there's any problem you can discuss on the WhatsApp group. I hope you people have taken the snapshot. Now let's discuss IAS 36, impairment of assets. The first thing in calculating impairment is the difference between the carrying amount and the recoverable amount. Impairment is equals to carrying amount minus the recoverable amount. Okay, previous slide for you people. Simran wants to view this slide. Simran, quickly take the snapshot. Okay, so how do we calculate the impairment? Impairment is calculated as carrying amount minus the recoverable amount. And what is recoverable amount? Recoverable amount is the higher of fair value less cost to sell and the value in use. What is value in use? It is the present value of all future cash flows. So if I'm using the asset, the amount that I can generate is called value in use. If I'm using the asset, the amount that I can generate is called value in use. And if I am selling the asset, the value that I can generate is called fair value less cost to sell. So what would I do? Sell it or use it? What would I do with an asset? Sell it or use it? Whichever is higher. Whichever will provide me more benefit, I will do that. So that is why we say that the recoverable amount is the higher of the value in use, the value according to the use, and the fair value less cost to sell according to selling the asset. So if my asset is being carried at $10 million and my fair value is $6 million and I can recover $8 million, so the recoverable amount is 8. So I can only obtain the benefit of 8 from this asset, which means that recognizing the asset at 10 is actually overstating the asset. Recognizing the asset at 10 means that we are overstating the asset. So we should record a loss of $2 million in P&L. So we should record a loss in P&L of $2 million. So now how we are going to record the loss? Impairment loss shall be recognized in revaluation reserve, if any. If there is any revaluation reserve for the asset, we are going to record it over there with excess taken to P&L. So impairment losses are actually recorded in P&L if there is no revaluation reserve. But if there is a revaluation reserve, we eliminate the reserve first and then move towards the P&L. So if there is a revaluation reserve, we reverse, we eliminate the reserve first and then we move towards the P&L. Now there are certain indications of impairment which can be internal indications and which can be external indications. What are indications of impairment? Any event that may reduce the recoverable amount of the asset. Any event that may reduce the recoverable amount of the asset is called indication of impairment. By excess we mean, Simran, for example, the loss was of 10 and reserve was of 4. The loss was of 10 and the reserve was of 4. So the excess is 6. So if the loss is 10, asset credit by 10, revaluation reserve debit by 4, excess 6 taken to P&L. This is something similar to revaluation loss, already studied in IAS 16. So what is an indication of impairment? Any event that may reduce the recoverable amount of the asset is called an indication of impairment. If the source of information is internal, this is an internal indication. And if the source of information is external, this is an external indication of impairment. So internal indication is any event which we internally got to know that may reduce our recoverable amount is internal indication, and any event that we got to know that may reduce the recoverable amount externally from the outsourced information, that is going to be called external indications. Now, for example, an asset being damaged is an internal indication. Results below expectation is an internal indication. And development of intention to sell. If I want to sell an asset, if I want to sell this pen, this means that there is some problem with the pen. That's why I'm selling it. So this is also an indication of impairment. So asset being damaged, results below expectation, and the development of intention to sell, all these are an indication of impairment. Similarly, decrease in market value. If the market value of the asset decreases, this is an external indication. If the interest rate increases, the interest rate increase will reduce the present value and the value in use. So this is also an indication. And the technological advancements would also reduce our economic benefit because our technology is now outdated. So that is also an indication of impairment. So these are all indications of impairment. So normally we test an asset for impairment when we get an indication. But there are 3 assets which should be tested for impairment annually. There are 3 assets which should be tested for impairment annually, irrespective of whether we have got an indication or not. The first is goodwill. Goodwill should be tested for impairment annually. The second is intangible assets with indefinite useful lives that we have already studied in IAS 38. And the third is intangible assets under development. If there is an intangible asset which we are still developing, that should also be tested for impairment annually, because up and downs come during the development phase. Sometimes we are highly motivated that this is a good project. Sometimes we say what we have done. And then we say, no, this was a good decision. And then we say, oh, I think not. And then we say, yes, we can do it. And then we say, oh, the competitor has done it. So there are ups and downs. So during the development phase, the standard requires the impairment testing to be done at each year end. Hung, I think market capitalization is something not relevant to paper F7. That is something relevant to paper F9. Okay, now let's discuss the cash generating unit. What is a cash generating unit? The cash generating unit is the smallest identifiable group of assets. A cash generating unit is the smallest identifiable group of assets for which individual cash flows can be identified and measured. A cash generating unit is the smallest identifiable group of assets for which individual cash flows can be identified and measured. So you have to learn this statement. This is normally asked in the exam directly. Yes, Simran, I do teach paper F9 as well. So a cash generating unit is the smallest identifiable group. So if I have a CGU, I have 3 CGUs and a big CGU which contains these 3 CGUs. So this is also a CGU, this is also CGU, this is also CGU, and this is also CGU. So when we are impairment testing, we have to look at the smallest possible CGU. Assets which cannot be tested for impairment individually are tested for impairment by considering them as a part of CGU. So for example, I ask you how much cash this pen is going to generate. How much cash do you think this pen is going to generate? Can we calculate? How much cash is this pen going to generate? Can we calculate? Obviously not. So not everything can be seen as generating cash. But if I say that this camera, this pen, and this tablet, and this room, this is a CGU. Now this can generate a cash. The camera, the tablet, the pen, and the room. Now this is a recording room, a live teaching room. So now this can generate cash. So this will become a CGU. So we are going to try to check the smallest possible identifiable group to calculate the CGU only when the individual assets cannot be impairment tested. Whenever the impairment cannot be done individually, only then we are going to make a CGU. And loss in a CGU is allocated in the following sequence. The loss is first recorded to goodwill, and then to the obviously impaired asset, and then we prorate amongst the remaining assets that fall under the scope of IAS 36. And normally current assets are not under IAS 36. So whenever we are going to allocate the remaining loss, we are going to allocate them to the non-current assets only. So first the loss will be recorded in goodwill, then the loss will be recorded in obviously impaired asset, and then third, prorate amongst the remaining. Yes, Harsh and Muhammad Hunain. Actually, BPP and Kaplan, if you see BPP and Kaplan text, they would have rated this on the first, and this on the second, and this on the third. But if you refer to P2 study text of Kaplan and BPP, they have written this sequence. And if you refer to the accounting standard, if you directly open IAS 36 published by IFRS by the IASB board, they have written this sequence as well. So the sequence that we have to follow is actually goodwill first, and then the obviously impaired asset, and then to prorate. Simran is saying we should look at the smallest CGU of the big CGU. Yes, Simran. Actually, there are a lot of CGUs. For example, the camera, tablet, and pen is a CGU, which will be a part of another CGU, which will be a part of another CGU, which can be a part of another CGU. So there are a lot of levels of CGU. So we are going to start from the smallest level, smallest possible level. So quickly take the snapshot and then we will move next. We have only 3 to 4 more minutes. Now this is a question and a pretty easy question. So let's solve this quickly. Or you can try this at home even. I would suggest you to try this at home. The question is pretty simple. So take the snapshot of the answer. Now this is a difficult question, Simran. Do we follow BPP text or this? That is your call. Follow anyone. Both are correct. You have to solve this on your own. This is a big question, but I can solve you. I can give you a basic summary that this is actually the fair value less cost to sell, and this is the value in use. So the higher is 214600. 214600 is the higher of, and if you calculate the carrying amount, the cost was 248,000. Sorry. And this is the depreciation percentage. So you can calculate the carrying amount to see the impairment loss. And then you have to calculate the new carrying amount, which will be this. The asset was acquired on April 2014. So you have to calculate the carrying amount, you have to calculate the carrying amount, you have to calculate the recoverable amount, and then calculate. So you people have 2 minutes to provide the feedback quickly. Feedback of today's session, feedback of overall session. You people have 2 minutes to provide the feedback. Okay, thank you everyone. I'm reading your comments. Simran, the lectures are available online and you can revisit them as many times as you want. Okay, thank you everyone. Slide changes too fast. Okay, so now let's continue for a while. Let's continue for a while. And let's discuss IFRS 15. We will try to extend 5 more minutes at least, so that at least IFRS 5 is covered, and then you can cover IAS 20 on your own, and then we will be starting with final accounts in tomorrow's session. And if we get some time tomorrow, then we will try to solve IAS 20 over there, but at least we should cover IFRS 5 quickly. So there are actually certain criteria which should be met to be classified for an asset to be classified in IFRS 5. So for example, if I want to sell this pen, this pen is held for sale for me now. If I want to sell the pen, this is being held for sale for me now. But to classify this under IFRS 5, there should be certain criteria. What criteria? The first point, the management is committed to a plan to sell the asset. The management should be committed to sell the asset. The word commitment means that we have decided to sell. We are not considering, we are not thinking for an option that should we sell or not. We will see that if we sell or not. No, the management is committed that we are going to sell the asset. That is called commitment. Only in that case the first criteria will be met. So the commitment should be there. The company should not consider, the company should commit. Smita, we will see if we are required to extend the class tomorrow as well. We will see. The second point is an active program to locate a buyer exists. An active program to locate a buyer exists. This means that we will be searching for the buyer until we find one. The second point means that we will be finding the buyer until we find one. So we will be searching the buyer actively until we have found one. If I have tried to search and then I have said, okay, it's okay if I'm not getting a buyer, this means that my intention is not to sell. If I really want to sell the asset, I will continuously try selling it until I've got a buyer. Reasonable price is quoted. The price quoted should be reasonable. If I have overpriced the asset, no one will buy. If I say this pen is of $10,000, no one would buy the pen because this is overpriced. So the price charged should be reasonable. Asset is immediately available for sale, which means that the asset is going to be sold in its existing condition. If I'm selling this pen, I'm going to sell this in this condition, not changing the condition afterwards, not applying any repair and maintenance on this, not repainting this, not using this. I'm going to sell the plant in its existing condition. I'm going to sell the plant, the asset in its existing condition. If I'm using the asset, the condition would change. If I'm repainting the asset, the condition would change. If I'm repairing the asset, the condition would change. So the asset should be immediately available means available in its existing condition. Yes, Hamza, reasonable means market value. The fifth point is that it is probable that the asset will be sold within 12 months because we normally classify the assets held for sale as a current asset. So to classify it as a current asset, it is necessary that the asset should be sold within 12 months. So if it is probable that we will be able to sell the asset within 12 months, the criteria is met. Yes, Harsh. In IFRS 5, we are going to treat this as a current asset. And the last point is management actions should not suggest that the plan will either be changed or be withdrawn. So if my actions are showing that I may change the plan, this means I'm not committed. Both the points are actually linked. If my actions show that my plan may change, this means that I'm not committed. That I'm selling the asset, but I may use if it is required. So this means that management actions are showing that we may change the plan. No, we are committed. We are going to sell this, but let's see if we would require to use, we will use. So this means that we are not committed. So management actions should not suggest that the plan will either be changed or be withdrawn. Now, what will be the accounting in this case? The first is we are going to transfer the non-current asset to the current asset. The first thing is we are going to transfer the non-current asset to the current asset. And now we are not going to charge the depreciation further. So for example, if we have declared the asset as held for sale in the mid of the year, so we would obviously charge depreciation for the first 6 months. But after classifying in IFRS 5, no more depreciation. Because now it is a current asset and I'm not using this. If I'm not using this, why would I depreciate? So the first point is to transfer from non-current to current. The second point is not to depreciate once it is in IFRS 5. The third point is that the asset should be carried at lower of the carrying value and the fair value less cost to sell. You can leave this before impairment. So now the asset will be carried at lower of the carrying amount and the fair value less cost to sell. So for example, the carrying amount was 100 and at the year end, the fair value less cost to sell is 80. So I'm going to write at the lower of, which is 80. And if the fair value is 180, then I'm going to write it at 100. Simran, I have cancelled before impairment because that would confuse you people. So asset being transferred from non-current to current, no more depreciation, carried at lower of. So you have to remember 3 points. Move from non-current to current, no more depreciation, carried at the lower of. Now again, you have to try this question at your home. This is your homework. And we will be switching off the session now. Yes, Hamza, carrying value means net book value. Yes, Simran, non-current asset credit, current asset debit. So you have to try this question at your home. If there is any problem, discuss that on the WhatsApp group. And IAS 20 government grant, you have to again try it, study it on your own. This is the entire accounting and few questions. So take the snapshot of the question so that you know the answer. Quickly take the snapshot of the question. Previous slide. Take the snapshot of this as well. So there is only one slide for the accounting of government grant, so you can try it on your own. And then you have to do this question, mark the answer. And then you have to apply, check this question and also mark the answer. Umar, your question will be answered by the management. Okay, this is the homework answers. I had given you a lot of questions in the homework. These were the day 1 homework answers. These are the day 1 homework answers. And day 2 homework questions are also attached, so you have to refer to those as well and take the snapshot of this also. so that when you are trying the question at your home, you can easily check the answers. Anyone who wants to join the group can message me on WhatsApp on this number. As if there is any other problem, you can discuss with me, but try to discuss the questions on the WhatsApp group so that a lot of people are there to answer you. So that's all for today, and thank you so much, everyone. Looking forward to meet you all tomorrow with the topic of final accounts and the preparation of the financial statements. Take care, everyone, and Allah Hafiz.